day. Welcome to Accounting Module 1, Contact Class Session. My name is Inge Shikangala. I'll be your tutor for this year. You can contact me in two ways, through a cell phone and email. The cell phone number is 081-150-11117. The email address is ishikangala@yahoo.com. But you can only contact me on Fridays, Saturdays, and Sundays. You can email me or text me the whole day, basically anytime during the day, but I will only be able to attend to your query or anything that you want me to respond to you on Fridays between 5 and 7. Saturday and Sunday is from 4 to 8 o'clock. Otherwise, throughout the week, you can email, you can text, but I will only be able to attend to you during those hours. Well, welcome again. I hope that you are going to enjoy this module this year. I will enjoy it. I'm already enjoying it. In this session, we are going to look in brief at the subject content. In brief. It won't cover everything, so I need you please to listen very carefully and pay attention. So the session will cover some tips also for how to prepare for the assignment and also for the examination. But please, again, as I said, I need you to pay attention carefully and try to understand as we go through the session. It's important that you get to understand the theory that we are going to discuss, because if you don't understand the theory, you won't be able to apply it. Accounting is a number subject, but those numbers are governed by theories, rules, and it's those theories that you are going to you need to understand so that you can be able to apply it to the numbers. Okay, that's the subject scope. You will see it's exactly the same as your school subject, as indicated in your school subject, so there's not much change there. Okay, Unit 1. The good question: what is accounting and why account? Why accounting? Accounting is defined as the analysis, classification, and recording of financial transactions. The ascertainment of how such transactions affect the performance and financial position of a business. It provides an overall picture of one's financial status. Let's go back there to the ones that are bold. The analysis, classification, and recording of financial transactions. It provides an overall picture of one's financial status. For example, let's say that you get your salary, your monthly salary. Then you spend it over the month. At the end of the month, you want to know how you spend your salary. So to do that, for you to know that, you need to record all your expenses that you have incurred, all the things that you bought during the month. As you record those things, you need to classify them in different categories. For example, Monday I bought cooking oil, Wednesday we bought bread, and then Friday we bought chicken. But at the end of the month, all those transactions will be grouped under food. So that is when they are referring to as classification. A transaction in accounting must belong to a certain group. Yes. And then at the end of the month, after you have grouped all your expenses, what you have bought now during the month, so you'll be able to see how much you spend on food, how much you spend on electricity every week, how much you spend on mortgage, and so on clothes, and so on. Now, you classify those transactions, you have summarized them. Now, you look at that information and try to learn something from it. So at the end, you will see just how much you have spent on food or on clothing. So that whole picture is now one's financial status. you can see what you have done with your salary, how you have spent it, how much, and on what. So now you can analyze, and then you will see, oh, look at this, we have spent so much on electricity. Okay. So hence, accounting is actually concerned with the recording of data, classification and summary of that data, and communicating what has been learned from the data. Communicating, if you are the head of the family, you can actually sit down your family and say, guys, look, it looks like this last month we have spent so much on electricity. We have spent more than we usually do. So what's going on? So now you are telling the family member basically how you have spent your financial status. That's communication. Okay. There are various branches of accounting: cost and management accounting, financial accounting, auditing. Cost and management accounting is normally has to do with preparing information for internal users, like management, most of the time for decision making. Financial accounting is for external user, like potential investors, for them to decide, to help them decide whether they should invest in your business or not. Auditing, this is a special one. The objective for this part of accounting is to determine whether the recorded and the reported information are a true reflection of the business transaction. It means after you have now looked at your salary and how you spend it, you then go and get that trusted cousin of yours or sister or brother to come and have a look at the way you have recorded your transaction to see if it's a true representation of really what happened, or maybe there are some errors in there or some untruthness there. So that person you are calling in to double check your work is an independent person coming in with an objective eye. And then that person will now tell your family to say, oh yes, it's true guys, last month you really did spend so much on electricity. Your father or mother or sister was not lying. Yeah, that's the purpose of the auditing portion. In addition to that, you have business ethic. Basically, it serves the same purpose, just to encourage business women and men to, to abide to certain code of conduct that will encourage public confidence in the product and services. So it's in addition to that. Users of accounting information, we have external user, internal user. The internal users, employees, they want to know if maybe next year, the year after, they will have jobs. External user, potential investor, as I said earlier, whether to invest in a business or not. The accounting equation, the magic equation, the equation that does it all. So everything a business does affects this equation. Learn this equation, understand the different components, and learn how to use it and how it works. Assets, that's property or money owned by a business. Owner's equity, money owned to business owners. Liabilities, money that must be paid back. Yes, learn and know the equation in your head. The basic principles of accounting. The basic principles of accounting, we have the system of recording financial transaction. It's actually called double entry bookkeeping. It recognizes that there are two aspects of every transaction, the dual effect. One account is debited and the other is credited. So, for example, if you buy a car, let's say cash, then you debit your vehicle account and credit the bank account. So both these transactions affect the assets. One increases and the other one, the credit one, reduces. Ledger accounts and trial balance. So in accounting, you have that process. First, an event happens. So let's say somebody came and paid their accounts with cash. So you issue a receipt to that person. And then that receipt is your source document. From that source document, the receipt, then you go to the cash book to record that transaction. The cash book is our subsidiary book, books of prime entry. Yes. Then from the cash book, then you record to you transfer to the journals, then to the ledger accounts, then to the trial balance. So there is a process there. There is a process there. So in the ledger accounts, from the journals, all the transactions are transferred to the ledger accounts. When the ledger accounts, from the ledger accounts, the balances of the ledger accounts are transferred to the trial balance. So they are basically just books that are maintained in the accounting system. A trial balance is a check on the arithmetic accuracy of the posting to the ledger accounts. This is where final accounts of the business can be drawn from. A trial balance, what goes to the trial balance are balances of ledger accounts. The trial balance is a credit and a debit column. And those two, the totals of those two columns, they must equal. If they don't equal, it means there is an error in posting somewhere, whether in ledger accounts or somewhere back in some of the books, there is an error. But when they equal, it's an indication that all is well. That's hence why they are saying it is a check on the arithmetic accuracy of posting to the ledger accounts. Okay. I talked about subsidiary books earlier. What is a subsidiary book? It's a book of prime entry, book of first entries, sometimes also referred to, and they are drawn from source documents. On the first column there, we have the books, subsidiary books, then just some example of transactions that can happen and that can be recorded in those books. And then the third column, we have the source document from which the subsidiary books are drawn from. Okay. Then we have features and use of debtors and creditors journal. So these are actually if you go back a bit, it's some of our subsidiary book. So the debtors journal and the creditors journal. How are they used? Let's go to the example that is given there, Chachara Bakery. So it says Chachara Bakery sold 10 loaves of bread to Miss Due on credit worth $100. So in the debtors journal, you will see a recording that says Mrs. Due $100. So in the debtors journal is a list of all debtors that owes Chachara Bakery. Creditors journal. Chachara Bakery bought 6 bags of bread flour from Pick and Pay on credit worth $150. So you debit purchases and you credit Pick and Pay. So in a creditors journal, you will see Pick and Pay is entered there. Pick and Pay $150. The creditors journal has a list of all Chachara's creditors. Okay, let's go to debtors return journal and creditors return journal. Now, what if now Miss Due returned something? In that example, you see Miss Due returned 3 loaves of bread because they were still raw at the center. When now the products have been returned to the business, what happens? They are recorded in the debtors return journal. And there, in the debtors return journal, is a list of all the debtors that have returned goods and the value of those items. Mrs. Due, $30. The same goes for the creditors return journal. So, Chachara's Bakery's creditors return journal will have Pick and Pay in it because Chachara returned 2 bags of bread flour to Pick and Pay because they had already expired and they are worth $50. So in that creditors return journal, you find all the creditors to whom Chachara have returned something. So Pick and Pay will appear there and the goods worth $50. And then from our subsidiary book, we have 6. There is another one, that the general ledger. The general ledger is a subsidiary book in which they record all the transactions that do not fit in those other 6. They don't fit to be recorded in the cash book or petty cash or debtors or creditors or debtors return or creditors return journal. They don't fit in any of those. So they are recorded in the general journal. For example, Chachara donated 20 loaves of bread to Hangana Daycare Center. So there it is, donations are debited 200 and purchases 200. You have reduced the goods that you were supposed to sell, but now you have, so it's credited, purchases are credited, and then you donated it. So there is various of transactions that can be recorded in the general journal. And these are some of the type of transactions that can be recorded in the general journal because they don't fit anyway. For example, down the correction of errors. When there is an error made, correction needs to be done. The corrections are done in general journal. Or bad debts. Nobody really wants bad debts, but it does happen that some of the debtors are unable to pay. So they are also recorded in the general journal. Just I urge you to read more on these transactions and learn how they are posted, or do some practical example. You can even Google them. You will find a lot of examples. But your prescribed textbook does have a lot of examples, so use it. If you can, get yourself a copy and use it. And the prescribed book, but that means I mean this book. So please, if you can, get a copy for yourself and use it and read it. But don't limit yourself to this. You can also Google and you'll find more examples on these transactions. Okay. Unit 6. What is bank reconciliation? It's a reconciliation of the bank balance according to the bank statement with the bank balance of the cash book. Its purpose is to explain the differences between balances on the bank statement and cash book. It's normally a result of unpresented or end-age check or uncleared and outstanding deposit. Okay. How do we prepare a bank reconciliation? There are 2 ways to prepare a bank reconciliation. One is by starting your recon with a bank statement balance, and 2 is by starting your recon with a cash book column balance. Remember, as we said earlier, it reconciles the 2 balances, the one for the bank statement and the one for the cash book. So, hence, for example, the first method, you can prepare the bank reconciliation as bank statement balance, then you less unpresented check, then you add the outstanding deposit, and then it will bring you to balance per cash book. But if you choose to prepare using the second method, it means you have to start with balance per cash method, and that balance you will get it from your cash book, the bank column. And then you will deduct the outstanding deposit, and then you will add the unpresented check, and then it will bring you back to bank statement balance. So it's just vice versa, basically, whichever one suits you. But many times people start with bank statement balance. Okay. Let's look at Chachara Bakery again and see if we can have a nice example for preparing bank reconciliation, a practical example. So Chachara here, this is Chachara's books, is at 30 June 2021. Bank statement balance 3,000. Miss Due paid the account by check, $25, but the bank only cleared that check in July. And then a check, Chachara made a check for 500 to pay City of Windhoek, but they did not take it to the bank. Then Miss Due came again and paid $50, deposited $50 into the bank, but the bank deposited the money to Miss Chachara's personal account. The bank made an error. So how can we draw the bank reconciliation from there? As we said, you can start. This example is as per the first method. You start with the bank balance, bank statement balance, which is 3,000. 3,000. Okay. Then less the unpresented check, the check that Chachara wrote for City of Windhoek, but they not taken to the bank yet. That's 500. Then you add the outstanding deposits. Miss Due, the 25 one, and then the $15 that is been deposited to Miss Chachara's personal account. So the bank must do the correction and bring that $15 to Chachara Bakery's account. Then it brings you to the balance per cash book. Okay. And then if you want to use the second method, then it's vice versa. You start with the 2,540, then you deduct the 15 and the 25, and then you add the 500 and to bring you to the 3,000. Okay. As I stated earlier, when corrections are done, they are done in the general ledger. And below here on the first column, we have the different, we have errors that are made that do not affect trial balance, and then there are errors that are made that affect the trial balance. For example, errors of omission. If you fail to record a transaction from completely nowhere in the books, in your books that is recorded, it's not going to affect anything because it's not recorded in any way. It's non-existent basically. So your books will still balance. And then errors that affect the trial balance are, we can even look at the first one, an addition error in an account. So when you are adding, you might have, instead of adding to get a 700, you added and then you get a 7,000. That will affect the trial balance. Okay, and so the ones affecting trial balance there are just 3, but the others are plenty. Also, I urge you to read more on this so that you can get more examples on these ones and know how they are treated. As I said earlier, in this session we are just looking in brief. So go and read further and understand these errors. Accounting principles. Accounting principles. The accounting world has developed accounting rules to help businesswomen and men share the same understanding of accounting system. Some of these rules are termed as principles and conventions. Principles being the notion and the idea underlying the accounting sphere. Conventions being the method by which concepts are actually applied to a given situation. There are various accounting principles. We have, so in summary, one can actually say they are really just rules or standards to help everybody prepare accounting information in the same way so that people can be able to compare irrespective of which country you are or which continent you are. This information is prepared in the same manner and you are able to enable you to do comparison. Okay. Accounting principles. There are various of them actually, and these are some of them. Business entity just talks about that one should differentiate between a business in that it's separate from its owners. Going concern, to know that the business will continue in the near future. Money measurement, only transactions that can be measured in monetary are recorded in accounting. Historical cost, business transactions are recorded at their actual original cost. Duality comes down to acknowledging the double entry system and that there are always two aspects or two accounts that are affected. Realization state that the revenue, when earned, it should be the revenue is collectible only when the debtor or whoever that bought something is legally bound to paying. Then it can be considered as a revenue. There are many others. Consistency, prudence, accrual matching, substance over form, materiality. There might be more. Go and read these ones into detail just to understand. It's just rules, basic theory, no calculations, not much calculation to it, but just read for a deeper understanding for yourself. Don't limit yourself to the prescribed study material. Okay. Capital expenditure, capital receipt, revenue expenditure, and revenue receipt. These are just some of the terminology that you need to learn and understand and be able to differentiate them. Capital expenditure, any acquisition of asset that increases the value of a business, current asset. Capital asset, money received from sale of an asset, even an old car that you can no longer use. The money you get from that is a capital receipt. Revenue expenditure, all expenses incurred in order to run a business on a day-to-day basis. Revenue receipt, income such as rent, even from your sales. Know the terminology and understand them. Also Google for example, so that just to broaden your knowledge on this area. Unit 7, financial account of a sole trader. In a sole trader business, the owner contributes all the capital. So all the profit and loss made by the business belongs to the sole trader. So when the sole trader needs to know whether the business have made an income or loss, the business have to prepare two financial statements, and that's the trading account and the profit and loss account. In the trading account, we are looking for how much profit the business have made. And in the profit and loss account, we are looking to find out how much net profit the business has made. So the trading account and the profit and loss account, they are prepared by following certain formulas. The trading account is, we are looking for gross profit. It's actually gross profit equal to sales revenue and cost of sales. Profit and loss account is net profit equal to gross profit less other expenses and plus other income. The cost of sale has a further formula to it. Cost of sale is opening inventory, okay, plus purchases minus closing inventory. But purchases, sometimes you have purchase return, so you have to deduct those purchase return from the purchases. And sometimes you have carriage inwards, transport, so you have to add that cost also. Sometimes a business can have more than one department that generates income. So in cases where business has more than one, each department at the end of the month or the year, the business must prepare a the financial account for both the department. Why? Because you need to find out which department is making profit or not. And let's look at one example. Let's go back to Chachara Bakery. So Chachara Bakery, they have one department that specializes on bread making, and the other department specialize on the making donuts. So, and then the expenses for the month there is the rent, electricity, and advertisement. The rest is just extra information. Opening inventory, closing inventory, purchases, carriage, wages, and revenue. So let's see how to prepare trading accounts for two departments. It's actually the same format, but you just have two different columns for the two departments. So you have your revenue there, cost of sales, and then you have your closing stock. So in the trading account, as we say, you are preparing gross profit, and then you prepare again departmental profit and loss account. Then here you take your gross profit from the trading account, you transfer, and then you continue to add income and less expenses to get your net profit. Okay. Financial accounts of the sole trader. Here really what I just want you to remember something. When people talk about bad debt is an amount owing to a business which will not be paid by the debtor. Remember, the longer the debt is owing, the greater the risk that it will become a bad debt. Okay, so basically, the longer debtors or somebody is taking to pay their account or whatever they owe you for, the higher the risk or the chances that they will never pay that money back to you. Provision for doubtful debt is an estimate of the amount which a business will lose in a financial year because of bad debt. Provision for doubtful debt is calculated as the amount owing by the debtor after deducting the bad debt. So, provision for doubtful debt is basically if you have 5 people who owes you, and then you realize the 3 people really they have taken so long to pay you back your money. They say they are going to pay the following month, but now in February, but now it's November. They have not paid you money. You are starting to doubt whether they will be able to repay the money to you. So for those 3 people, you create a provision for doubtful debt because you are questioning whether they will be able to repay the money back to you. So only for those 3. Okay. That's basically the content at the end of the subject content. But before I close off, I would like to discuss some tips with you on how to prepare for the examination. First of all, like I said, again, I'll repeat, I urge you strongly to get yourself a copy of this. It will really help you. If you can, please get a copy for yourself. It will really, really help you. There is a lot in here that can upgrade your understanding. Okay? You spend enough time reading the prescribed material and follow the instruction carefully. Read the theory and understand it. And do practical examples. If you don't get to understand the theory, you will not be able to apply it to the numbers. And accounting is all about numbers. The theory only governs the numbers, but in the exam or the assignment, you will have a lot of questions that are number oriented. So understand the theory so that you are able to apply it to the numbers. Okay, in the exam or assignment, attempt as many questions as possible. Start with the easiest ones. Never leave a question empty. Give it your shot. Give it your shot. And if you attempt a question, do a proper job on it so that you can harvest as many points as possible. Some students, they know something, but they are taking shortcut on some things, in a process losing some marks. Do a proper job on that question to get as many marks as possible. Revise your assignment. Do as many practical questions, not just limiting yourself to the prescribed information. Go on the internet and browse and see how others have calculated something and use it also. It's important to, it helps to learn or to upgrade or to improve your typing skills, you know, especially if you are going to write online. It really does help a lot. So if you can, and if you get a chance, ask your friend or cousin and use their laptop to improve your typing skills. Thank you very much.